show y'all a little back office secret on how
Uh-oh.
stuff I've been doing, uh, creating people's wealth, man. This stuff is amazing, man. And I wanted to show y'all. Okay, let me ask everybody. Everybody on the call, who on the call has a 401k?
Well, I do with Andrew.
I did.
Like pretty much everybody, huh?
Yeah.
Okay. All right. I'm gonna pull up something, show y'all something simple. Okay, I'm finna share my screen. So y'all can check this out. All right, so this is an illustration for retirement. Okay, this is how we use retirement. We use insurance policy for retirement. Okay, we're not focused on death benefit. This policy is focused on, say it again with me, retirement. Okay, what is crucial at retirement?
What was the question?
What's important for retirement?
Have some lump sum of money to rely on.
Right, income, right? You gotta have some, still gotta have some money. You gotta have something saved, right?
Yeah.
Okay. They've created the system of retirement as if you just stop working, but some people don't never stop working. But they put this system in your mind so that you would think for the future, but you would actually place your thoughts and trust in somebody else's control. Okay. 401k is the biggest scam that they one of the biggest scams outside of the financial system. It's part of the financial system. So it's still all in one, but it's one of the biggest financial scams where they've tricked consumers into believing they're better off going into business with the IRS for future taxation so you can delay it right now and hope for it'll be better in the future without accounting for the aspect of population growth, inflation, as well as a dead economy, okay, and a system or a new deal that didn't work. Okay, and people living a lot longer. Let's say it that way, because back in then when they was doing this, people was expecting to live to their 60s. Well, people living to their hundreds now. So if you only made a pot big enough for people in their 60s and they're living longer and the population boom, you miscalculated, right? So you didn't make enough food for everybody. So now the end result of that is, some people are just not financially in a situation where they can retire and they have to keep working. But what I'm going to show y'all is the power of what they have now that's probably only been available. I'm going to say this aspect because this is an IUL, okay? You can't do this with no other type of product in the financial services but an IUL. You can't do this with a whole life and you can't do this with a term. It has to be indexed because the index guarantees you 0.25 interest at the worst versus a stock market. The loss in the stock market, which is where everybody 401k is volatile based on the social financial system, right? So if we're in a deep depression, what's going on with the stock market? That is zero. Well, why would you put your money for retirement in something so volatile? Most people don't understand the 401k, right? They're thinking it's something good, and the IRS got you in their best interest, right? Well, why would I put off something for later when it's gonna get worse for later? Whose interest is that in? The person taxing you. Okay. So what I'm going to show you on the screen is this is a gentleman at 25. Okay. This young man is putting $500 a month towards his retirement. Okay. Towards his retirement. This is strictly retirement. Okay. So that's $6,000 a year. Okay. Now, for those on the call, let me see, Gerald. Okay, I think Gerald's the only one on the call that actually has one of these. So Gerald can understand this, and if he doesn't understand, he's going to learn today. All right. So this is what this information. I'm going to break down what this information is so that y'all can understand it. All right. You see these three categories right here, right? You have guaranteed, non-guaranteed, and non-guaranteed. All right. The one on the left, this is a worst case scenario. That means if the stock market was to do zero, this is the worst case scenario. Okay, when I say zero, that means I say downturn. That means if it crashes, that means anybody with this company, this is what they still going to guarantee you on your return. Okay. Now, the second is middle, 4.75 average. We're going to say that's the average of what it could do. Over here on the right-hand side, this is the max that we can show or tell people. Okay. They don't want insurance agents showing consumers anything higher than this because they don't want to give consumers false hopes. All we can give consumers is data of what happened in the past. We can't predict the future. Okay, but the insurance company is going to guarantee you we won't let you lose anything less than 0.25%. That's what the insurance company is guaranteeing if you constantly let them hold your money. Okay, that's what they're saying with this. Now, what benefit do you get that first year of giving them $6,000? Well, on the far right, we're going to mainly look at the far right, okay? On a good day, your $6,000, you're going to have an account value of only $44,620. Do y'all see the difference between that? I need to make sure y'all, engage with me on this.
Yeah.
I want to make sure y'all follow me. Okay. So we got 6,000 going in, but you only have an account value of $4,000. What that means is they took out fees from your deposit. Okay. Because this stuff ain't free. They got to pay people to work. So they take the payments out your money you make deposit. But what did they give you in exchange for that 6,000? Well, if you die in that year, they're going to give you $371,000. Everybody see that?
Yeah.
Yeah.
Now, in that first year, if you needed to make a loan, that's how much they would give you. That's just the first year. Okay. Now, let's watch and look out. Let's go down to about the 10th year. We're going to jump on down and make it get real interesting. So you've done this consistently for 10 years. That means you would have contributed $60,000 to this policy. Okay. Just this policy. Now, on a worst case scenario, the account value would be only $41,000 on a worst case scenario. But you still would have a death benefit of $408,000. So is that worth it? Is 60,000 worth 408,000?
Yeah.
Yep.
Okay. Okay. Now, keep in mind, we're only talking about this is just one policy. All right. Now, let's look on down over here on best case scenario. You would have an account balance of $64,000. Did y'all see what happened right there? Anybody can just tell me what's going on right here in here?
Interest.
Yeah, interest, it compound.
Okay, it's starting to do something. It's starting to move so much so you've already got your money back. Do y'all see that?
Yeah.
You got your money back and you profited. What about your death benefit? It also has increased from what it started at.
Right.
All you've done was gave them and let them hold that 60,000 that you couldn't have put nowhere else that would do something like this for you. Okay? Now let's keep scrolling. Now, remember, that's from young man, that's just the age 35. Now let's jump and do another 10 years. Okay? Now we have 120,000 he's paid out of pocket. Worst case scenario, value would be 82,000. Okay? The death benefit would be 450. Jump over here on best case scenario, the value would be $207,000. But he only put in 120. Okay? But that death benefit is over $500,000 now. Okay? Now, let's scroll on down a little further. Something's going to change here. Okay? We're going to go all the way down to age 61. What happened at age 61, y'all.
He don't have to contribute any more money, it looks like.
Yeah, he don't have to put no more money in. But what's going on right here in the second column now? This withdrawal and loans column.
Taking money out.
So you take, yeah,
All
they
right,
would
for
take
the year, now he gets income. 67,000 the insurance company is going to pay him that year. Okay? And he still has a death benefit in worst case scenario $434,000. Or best case scenario, the account to be worth 860,000 and he still has a death benefit of $1.15 million, y'all, at age 60. Okay? So if he dies, he gets this over here. If he keeps living, every year he gets $67,000. Let's see how long he gets that money. He gets that until he's 90. Okay? That means he would have only contributed. How much did we say he contributed over the years? What was it? Let's go back up. Did anybody remember what it was?
120?
Was it the 216? Remember, it's the 216. He's only put 216. He stopped at age 60. That was his last contribution. Okay. So from that age of 25 to 60, he only put in $216,000. Okay. He has a maximum death benefit of $1.1 million. Okay. And at age 61, he can start asking them, or they're going to start kicking him out a check for 67,000 a year, all the way from 61 to the age of 90. Then at the age of 90, the checks will stop. If he lives past that, look how much money he would have received at that point. Over $2 million of tax-free income when he's only contributed 216,000 out of pocket, y'all.
Pretty impressive.
A 401k can't do this. Okay.
Mm.
Then he still, even when they stop paying him, he has a death benefit of 428. He won't get no more checks, but look at the death benefit. Okay, because now it started to diminish, but is he losing? Is this a loss?
No.
Thank y'all. Because look at that death benefit. If he keeps on living, he don't get no more income, but hopefully he put that money to use, right? That $2 million, I'm sure he could have put that $2 million to use, right? Because I don't think nobody in their 80s and 90s needs 67,000 a year. When at this point everything's paid off, right? And remember, this ain't the only policy he has. Okay, this
Mm.
is just the one set up for retirement. Okay. So even if let's say he lives to 100 years old, it's still the heirs, the beneficiaries, still gonna get close to $500,000
Mm-hmm.
to leave to his offspring. Okay. Now let me just show you. I'm gonna show y'all how what this looks like. Watch this. Okay, so this is this company called F&G. Oh, I got to log back in. They want me to log back in. Okay, I'm gonna run one. I'm gonna do one on myself real quick. Come on. Yeah. All right, so let's see. We go on the illustration. Boom. Let's see. View my cases. I think I did one on me already. Here it is right here. All right, so here's the one I did on me. Come on. All right, so all right, let's see. USPDF, can I make it larger? Those movies first, let me see if I can open like that so it make it larger. All right, just give me save. We just look at it like this. All right, y'all can see this, right? Right, can see this?
Yeah.
All right, so this is a
Yeah.
policy for me. Now, this is how this stuff works, y'all. Okay. When you're signing a contract, because we're speaking about contracts, so this all goes hand in hand because the funny thing is when I went to take my license for this test, I realized I taught 80% of the information. So when I went and took the test, I was able to pass it with a 91. Okay. The other 20% that I had to learn was how this stuff is regulated by state because it's not regulated through the government. Okay. So that was the part I had to learn. All right. So everything starts with a contract. A life insurance policy is a contract. Okay. You are betting with the insurance company that you're going to die at a certain time and they're betting that you're going to live. That's all you're doing. So it's based on mortality. So with these circumstances, and understand that this business model has been around for over 100 years. So it works. Okay. Technology has allowed it to be more efficient, to do a whole lot more things and to think about stuff the average person doesn't think about. Does anybody have any idea why a credit report is an important piece of insurance policy?
I don't know. Couldn't tell you.
Okay. Well, statistically, people that are in debt live shorter lives than those that are not.
Okay.
Does that make sense?
Yeah.
Stress,
Straight. Yeah, I was about to say yeah.
it kills you. Okay. So on the surface, you wouldn't think that that's important, but that's what they're using that for. They're not using it to count you out. They're using it on how to rate you because in the insurance, they have different ratings. Okay. So we typically come in with a standard rating to try to get everybody approved, which is non-tobacco standard rating. Okay. If they go look and see that they think that you're better than that, they'll move you up to something called preferred. Okay. So that's what I wanted to make sure y'all understood just about that. That's what this document is about. Okay. So when you understand what it is one thing, but when you understand what you can do with it, that's a whole game changer because the average person thinks of this with a mindset of it being an expense and something they don't have nothing to worry about because it only helps them when they die. Okay. They don't know that you can use this for a source of income for retirement now. Okay, so that's what I'm showing y'all here. All right, so that's what we have here. And I don't know why I did the state of Florida, but it's fine. All right, so just look at this policy. So this policy is based on $1,000 monthly, okay, put away for retirement. Now the other one I showed y'all was what was the amount?
500.
500. Now, what was the difference between the people in that document? Anybody know count the difference?
The age.
There you go. Age. Age is different. So who do you think got a better rate, me or the young man at the age of 24?
The younger.
Right. The
Yeah.
younger, the better. He has a longer time to contribute than based on what the statistical life expectancy is of a young black man. Now, men and women are rated differently because women live longer than men. So who do you think could get the best policy between a man and a woman?
A woman.
A woman. Okay. So when you know these types of things, you can use it for strategizing and leverage. So let's say maybe you couldn't get approved for a policy. Well, then you would use your wife to get approved for the policy. Maybe you're trying to use the policy for banking. Well, you won't get the benefits of the death benefits or of it, but she can get the living benefits, right? But y'all get the living benefit of being able to create a source of income through your transactions by just having the policy. Okay, regardless of who the death benefit is, what does it do for me while I'm alive? Is it going to protect my income? Is it going to guarantee me an income for when I retire? And is it going to be able to convert my expenses into income? If your policy can't do that, you got the wrong policy. On top of, is it going to cover me if I don't die and I get sick and can't go to work? Okay, that's part of covering your income. All right. So with this policy, with my age, if I was contributing, now the older you are, unfortunately, the more we have to contribute to try to catch up for those years that we missed. Okay. So that's what you also got to take in consideration. Now, even with what you see me having with an initial premium of $1,000 monthly, this company offers what's called a monthly no lapse premium, meaning what let's say I run into a tough month and I can't do that $1,000, man. I run into a crunch. Well, if I could at least do $229.30, I can keep the policy intact without it lapsing. Okay. The only difference is I can't expect to have the same type of access to income at this number because the estimate is done at this number. Does that make sense?
Yep. Yeah.
But it's better to have something than not to have nothing because I can come into a better year or a better month where I can catch up on those payments that I was low on. Okay, so that's how it works. That's the flexibility that I have in here. And let's say I come up across a good year and I have a lump sum of money that I just want to go ahead and pay it up for the year. Well, I can do that right here. Okay, I can do that. I can pay that thing up for the year. All right, so that's the flexibility we have in here. Now, let's get on down to the numbers of this one so we can see the slight difference with the age. Okay, now here we go right here. All right. Now I doubled up my payments because one, I'm a little older. Okay. So instead of 6,000 a year, it's 12,000. Okay. So we have this worst case scenario. Can y'all see this?
Yeah.
Okay, make sure y'all can see that. All right. So worst case scenario, that first year that I deposit 12,000 into that account, the value of it is going to be 8,000 because what we say happened in the first few years? Them fees get you, but the compound interest is going to catch up to it. Okay, but I still got a death benefit of over 3/4. Okay,
Can you
360,000.
can you
Go for
increase
it.
the your font a little bit? Because I can barely see it.
You can barely see it. Okay, let me just do this there. Let me go ahead and save it and then open it up that way. Whoa, whoa. I can even zoom in a little bit more. Now let's scroll on back down to them numbers. And you tell me if that works better for you.
Yeah. Yeah.
Boop. There we go. Asking we shall receive. All right. So me being at age 43, I'm jumping in 12,000. Most case scenario at that first year is only going to be worth 8,000. Okay. But I still got a death benefit of 364. On the good year, access is 95, 365 death benefit. Okay. Now we're going to jump down to 10 years of doing that, 120,000 in.
Can
Okay.
you go? Can you discuss? Uh, this is still year one at the far right end. Can you tell us what is the surrender value?
Yes, surrender value. Let's say I needed to do a loan. Great question. I'm sorry I didn't say that. This section would be what I would have access to liquid to do a loan. Okay.
Okay.
Now, the thing about this, we don't create this for loans. We have the bank for that. But worst case scenario, we also have that option here. This is with, let's say the bank, we don't have to cash out the bank and the bank went to hell. You know what I'm saying? This is a last resort type of thing. Okay. So we don't even, that's why I didn't even mention it because I don't even want you to focus on it, but that is an extra benefit of this policy. If you needed to take a loan, this section right here would let you know how much you would have access to. So in that first year, technically you would have access to almost 4 grand. Okay. But in the 10th year, look what you would have access to 127,000. How much had you put in at that point? 120,000. So you see how that will work for your benefit, but we don't even focus on this because that's not the intention of this policy. This policy is for retirement, but worst case scenario, that is what you would have access to. Now look at your death benefit, 486,000 when you've only contributed 121,000. Okay? Worst case scenario, they're saying the account value would only be at worth 130,000. Well, you only put 120 in, so you up 10 grand already in 10 years. and you got access to more than what you put in. So just in 10 years alone, was this worth it?
Definitely.
Definitely, because where else could you do something similar to this? Nowhere. No one's offering this but insurance companies, y'all. This is why banks put money into this on these policies on their employees because this allows them to put money somewhere. You got people, let's say somebody worked for a bank for 30 years, like my aunt. My aunt worked for a bank for 30 years. Okay, this is just year 23 of them depositing money. Let's say they had a policy on her and they was just depositing money. Look how much money they made off my aunt, and they've only paid 240, but they got a death benefit. If she was to pass, they could cash that out. Or they could take loans out, y'all. They could take loans out and collateralize and securitize it and make buku money off of $500,000, and they've only put in 240. Do y'all see the power of this? You can't get this type of returns in the stock market, y'all.
Yeah.
This money guaranteed. Well, we saying when I say guaranteed, what we say was guaranteed. The left side guaranteed. So even guaranteed death benefit of 500, they still guaranteed access on a worst day of 181,000 that they could collateralize. Or if this is you, well, like I said, this policy ain't for taking loans out. But let's say something came up and you just really had to get into an investment on a piece of real estate. Okay? Because the only reason you will be tapping into this is just to get another asset. Other than that, you will be destroying this if it wasn't to acquire another asset.
Uh-huh.
Okay? Why? Because this is your guaranteed income for when I get to age 66, I stop contributing. So at age 66, I've contributed 276,000, right? But I have access on the worst day to 181,000. I have a death benefit of $500,000. On a good day, I have an account value of 547,000. I have access to that 547,000. You see that? And
Right.
I have access to the full account value, y'all. And then if I was to pass away, my family get that amount. When I've only given them 276,000. Well, let's say I continue to live past 65. So at age 63, I tell them, go and start sending me 53,000 a year for me to live off of. Okay. Worst case scenario, I have an account value of 177,000 and a death benefit value of 480. On a great day, I have a account value of 587,000 and a death benefit of 848,000. All because I knew where to put $276,000 of my money for hopes and preparation in the future when I didn't want to contribute nothing and I just wanted to live off the compound interest with receiving $53,837 for how long? We started at age 66 and it stopped at age what? 90. At that point, I would have received $1.3 million in income when I've only contributed 276,000. Okay. And I would have a death benefit of at least $164,000. Okay. On the worst day, it wouldn't be nothing left over here. But yet and still, that didn't stop my income. So did I win or did I lose?
You
Yep,
are.
definitely one.
Okay, so y'all see this. This is strictly designed for what did we say?
You are.
Retirement income. Retirement income. Okay. So just with those numbers, do we have any questions about this stuff, y'all?
Um,
Did you say anything about tax implications?
That's tax-free money. That
Okay.
that yearly money you get is tax-free.
Okay.
Yeah, that's the beauty. That's the other part. It's tax-free, it's risk-free, and it's insured with thousands of dollars of other people's money. Because it ain't your money. You didn't contribute enough to receive all of that. But that's the interest from them using your money. Okay. So that's the thing. Now, like I mentioned before, the older we are, the more we have to contribute. But a lot of times, when we are older, we typically may already have a little nest egg or a lump sum from a 401k, and we're looking for somewhere to put it because we know, let's say, at a certain age, 59 and a half, what is the IRS pressing you to do? They're pressing you to start taking money out of there. Now,
Yeah.
if you wait, they're going to increase the amount they take from you. What type of business relationship is that? They ain't contributing, but they gonna tell you they gonna take your money, put it in stuff that's volatile where you can lose money, then tell you when you're gonna take it, or they gonna tax you to take more of it.
Whip off.
Isn't that crazy, y'all?
Yeah.
Definitely crazy.
Well,
Yeah.
if your employer is not matching you, you don't have no business giving them your money. If they matching you, that's good. You just contribute to whatever they matching because what does that mean? They're taking half the loss,
Yeah.
right? So that's a cool situation. Go ahead and do that. Let's say they was taking out $150 a week. Well, if you could put $400 somewhere else, you're gonna come out better than what you're gonna come out on that portfolio because there's no risk of loss with this policy. But with your 401k, there's a risk of loss, right? So that's why you want to contribute the least amount to that 401k because you're trying to get something tax free. Even in your 401k, outside the risk of loss, what happens when you get older? The taxes are higher. So when they force you to start taking it, now you got to take it or you're going to lose more money. So they put that fear in people's heart. But if you have, let's say you have diversification with your retirement. So some people might want to put some there. They might want to put some in this policy. They might want to put some in the IRA, right? There's nothing wrong with that because IRA grows tax free, but there's a limit on how much you can put in it. If you make too much money, you can't do no IRA. It ain't no limit on how much you can put on this insurance policy. The only limit is based on your income, right? How much you can afford to save because this is a savings account. It's not even an investment, y'all. We can't sell this as an investment. You know why? Because there's no risk of losing money. In order for it to be an investment, there has to be a risk of losing money. How you feel about that, Jewel? I just dropped on you.
Yeah,
Sounds great.
that's a game changer right there. There's no risk of losing money.
There's no risk here. I showed you. We just went over what the projection was based on historical data.
Right.
For this information to be wrong, the stock market would have to crash every year consistently throughout your retirement for this to you won't even lose. It would just grow super, super slow. Okay? Because it still have compound interest. Compound interest is so powerful, y'all. Just think about that. Compound interest, the power of it. If you take 1 penny and you compound it daily for 30 days, you will have 5.3 million something dollars. What does that mean? That means day one, it's a penny, right? Well, day two, it's 2 pennies. Day three, it's 4 pennies. Day three is 16 pennies. You see, now it's 32 pennies. Now it's 67. You see how it's compounded?
Hmm.
And if you do that consistently for 30 days, it's $5.3 million. Okay. Just to put this in perspective, we're compounding not daily, but annually over 23 years to create a $915,000 guaranteed tax-free source of income.
It's huge.
Okay.
It's huge.
That's the power of having access to the right information so that we can make better informed decisions on where to place our money.
You
All
should.
right, so we're gonna end with that. Now, this is just retirement. Okay. Well, next one we're gonna talk about replacing your income, and then we're gonna do another video a week after that just on banking again. So those are the three aspects of what we're calling the financial shield on why everybody needs to be everybody's focus because there's nothing better and more important than this. Until you have your financial shield, you really don't want to be focused on anything else because time is your greatest asset. Okay? Make sure you got yourself protected before you fight these enemies of wealth. Do you know who the enemies of wealth is?
Taxes, all right.
There you go. Every time you walk outside your door, it's taxes, it's expenses, it's unexpected situations. Brother Gerald had a situation last week where stuff was happening to him unexpectedly. These are all the enemies of wealth, y'all. So if you don't have your greatest financial assets protected, you're subject to be penetrated by these folks. They're gonna hit you somewhere. All right. So this is why I'm taking my time to show y'all this because you're not gonna get this nowhere else. Have y'all ever heard of this being possible? Anybody on this call?
No.
Nah.
Okay. This is financial freedom right here. Just knowing these little simple hacks right here, where you can live comfortably knowing if something happens to you, man, everybody's straight. Everybody's straight. Okay. They just follow the rules that I wrote down in this notebook over here. Okay. This is the law. I'm writing down the law right here. Okay. And this is something that the average person has never been access to, y'all. So please, take heed to this information, man, because this is valuable right here. And if anybody got any questions.